Hey traders, a lot of you asked me in my last video where I discussed taking a max loss on a credit spread, why I did not roll my trades. So I thought I would discuss that further. If you're new to options, the term rolling simply means that you're closing out one trade, opening another similar trade, future position in one order. And you usually do that when the first position has turned against you in some way. Rolling a challenged trade is probably normal practice for any day trader. So if the underlying is moving against you in some way, you make an adjustment to your trade 2 or 3 or 4 days from expiration, and you basically just give your trade more time to be right. But in the case of a 0 DTE trade, that's not always in the default plan for a couple of reasons. The first is the strikes are the strikes that day because they correlate with the support and resistance levels of that day. So carrying the strikes forward into another expiration cycle, or like for me, when I roll a trade, I always pick at least 2 expiration days away. So that's, 4 trading sessions. It's not really ideal. But having said that, 3 out of 4 times that I do roll my trade, it's a winner. And I've been, meaning that I've erased my loss entirely. So for that reason, it's a tool worth having in your tool belt. Let me show you the mechanics of entering the roll order in Thinkorswim, and then I'll talk about a couple other factors. All right, so what I'm in here is a put credit spread that I filled for 50 cents, 10 contracts, and that I entered around 9 o'clock in the morning Pacific Standard Time. I fast forwarded to noon when the spread did get challenged. To create the closing order, of course, I can see here that I'm about at 3x where I would normally stop out. This is what my trade looks like on the option chain. The short leg is about to go into the money. So to roll this order, you'll right click on SPX, you will create a rolling order, you'll select the first line that has the vertical roll in it, it'll bring you to the trade tab. Here is your current spread, and here's a new spread. So by default, it's entered the next trading day and it's kept the same strikes. You can change the strikes, you can change the strike widths, but it will require more buying power of you if you change the strike widths. So it's just in my wheelhouse to always skip the next trading day and go out to this expiration date. I always just pick at least 2 expiration days out. But know that you can play around with this and look for an acceptable credit. In a real money situation, and this is where your strikes are, you can probably expect to get around 15 to 20 cents credit. So the deeper in the money your short strikes get, the lesser credit you're going to be able to find here. If it's 3 strikes in the money, you might not be able to find credit at all. So I'm going to send this so you can see what it looks like when it's filled. Come back over to my monitor tab. And now, so long as SPX closes above 33.55 on October 5th, I will keep the 65 cent credit that I received. If on any day before October 5th, I can come here, right click, and close the order for less than 65 cents, it's a profit. So you have to look at this as your new trade. All right, so that's how you enter the roll order in Thinkorswim. In the case of a 0 DTE, you don't have usually a lot of time to make the decision. So in my experience, when a 0 DTE trade goes wrong, it usually doesn't go wrong slowly, right? So it's not like the price action was creeping toward my slow strike over the course of the day. It's usually some sort of news event, liquidation break, some type of plunging, or something that has pushed my spread nearer into the money. So timing is really important for rolling a same day expiration trade. The very first criteria that has to be met if I am going to roll my trade is that I have to be able to find a credit in the new trade. If I can't manipulate the strikes and the expiration dates and find that credit price there and I'm only getting a debit, then that of course means I would be paying to roll my spread, and I personally would not do that. Okay, the next question that I ask myself is, am I still bullish going forward on SPX if I was in a put credit spread? or am I still bearish if I was in a call credit spread? And most of the time my answer is yes, because like I said earlier, the reason my spread usually gets tested is not because I was wrong about the support or resistance level. It's usually because of some sort of manipulation in the price that has happened that day in order for my spread to have gone wrong. Also, the good news is that you're not opening yourself up to any additional loss. So long as you are able to find a credit in the new spread, you're actually reducing your max loss on the trade. So let me show you what I mean. As far as your worst case scenario, if SPX does not close above 33.55 and this strike ends up in the money on October 5th, your max loss is actually reduced by this much. So where before your max loss was $450 a contract, 500 minus 50, it's now 500 minus 65. So you did reduce your max loss by that amount. Let me forward this because this is actually a real trade that I did roll to this day, and SPX did close above 33.55. So let me pause this and I'll show you what the P&L looked like on that day. All right, so I fast forwarded to October 5th, 30 minutes left in the trading day, and you can see here that, these numbers on Thinkorswim will be skewed, so you really just have to go off of your filled orders screen. But you can see on the chart that SPX, here was our strikes, 33.55.50, and on October 5th, this is what SPX looked like. And of course, it's going to expire worthless. So this day was pretty sketch. Like, I'm sure I was stressed out this day because I was still facing a loss. But on this day, SPX gapped up and my trade was fine. I'll show you my actual fills. So, oops, that's my closing order. Here was my 9:30, 9 o'clock in the morning, sold to open 10 contracts. I received 50 cents. And then at 12:30, I rolled them and was only able to get 5 cents credit. So that's 55 cents total. And then on October 5th at 9 o'clock in the morning, and it took me a while, I guess, to get filled on all 10, but I ended up exiting for 10 cents. So where on the 30th I was facing a loss, I was able to recover it on the 5th. But of course, also keep in mind that your capital is tied up for these days. But that's how that worked out. All right, so you're not opening yourself up to any additional loss, which is good. Of course, timing is important. This is a same day expiration trade. So naturally, the time that you might be looking to stop out of the trade would be the time that you would be making a decision to roll the trade. Do not wait until your short strike goes too deep into the money, or this will not work for you because you won't be able to find a credit in the new trade. So to recap, 3 criteria have to be met for me to roll the trade. I'll only roll for a credit. I have to have the same direction bias going into the future. And also I have to be okay with my capital being tied up until I get out of this new trade. So sometimes, that's 3 or 4 trading sessions. So keep that in mind as well. Also, I want to be clear that you are realizing a loss on the first trade. So it actually will not appear that way because the value of your loss is factored into the new rolled trade. So your account balance won't reflect a loss, but you are realizing a loss on that first trade. All right, guys, I hope that helps you understand rolling a little bit better. But more importantly, I hope it gives you a little bit more confidence when you're entering a credit spread, because at least for me, when I know that I have this option, if my trade gets challenged, I feel a little bit better and less stressful when I'm entering the spread. There are other ways that I have used to sort of rescue a tested spread, but I'll have to make another video about that because they're more complicated. So if you have any questions, as usual, please comment down below or you can email